The times that I've mentioned so far have been 3 years to keep a tax return. Pretty much a rule of thumb, but there are other scenarios where it's suggested that you keep it for 7 years, 6 years. There are even a few that are indefinitely, but you guys know how I always give you the secret sauce? Well, just keep listening. I'll let you know how you don't have to keep your tax documents indefinitely.
Welcome to the Tax Relief with Timalyn Bowens podcast. Are you behind on taxes? Is the IRS threatening you or your business? Are you overwhelmed and confused about how to resolve your tax issues? Let's join Timalyn as she explains your options and how she may be able to help. Timalyn Bowens is America's favorite EA.
Hey, family. I am excited for 2023. 2022 was an amazing year, and if you heard the holiday message, you know that I am so thankful for you being a listener to the Tax Relief with Timalyn Bowens podcast. I promised you that we were going to start the year strong, and today I intend on keeping that promise. Episode 20 is going to be about tax records. Now, I get this question very, very, very often. Timalyn, how long should I keep my tax documents, my tax records? And just like many things with taxes, it depends. But let's talk about what it actually depends on, different scenarios that will change how long you should keep these tax records, and then we'll talk about how to store them. All right? Now, these details can be a little finicky. So for this, especially if you have a tax situation that you are thinking about already, you probably do want to get your pen and paper, because there are going to be different stipulations where the situation is going to change the amount of time that we suggest that you keep those documents. All right? As a disclaimer, when you tune into the Tax Relief with Timalyn Bowens podcast, you probably want a pen and paper anyway. But let's get right into it. So when I say it depends how long you should keep your tax records, there are 3 things that we're going to look at. We're going to look at the action, the expense, and the event. Now, what do I mean by that? For example, let's say that you purchased a home. When you purchase a home, any tax documents from that action, you're going to want to keep at least as long as you have the property. Okay? If we have an expense, and this is especially for my business owners, we need you to keep that expense document for at least 3 years. Now, I say this over and over again, but sometimes, family, I know you need a reminder. Anything that you are claiming on your tax return, it is your responsibility to substantiate. You need a third-party record. So when it comes to expenses, your bank statements are not good enough because they don't tell us what you actually purchased. Now, me as a tax professional, if I was preparing your return, do I want to see every receipt? Absolutely not. You should have an accountant/bookkeeper keeping those records with you, and they are going to be the ones that reconcile that with your bank statement to provide the tax professional with your financial statements, which are your income statement as well as your balance sheet. All right? But again, it's going to be up to you, your responsibility, the taxpayer. I'm emphasizing that because it's not the tax professional's duty to substantiate all of those expenses. Now, if you're listening to this, chances are pretty likely you aren't anticipating a refund, but I don't want to skip over that information just in case you're not on the IRS naughty list. You have 3 years to amend the tax return and claim a refund. So let's look at an example. If You filed your 2019 return during 2020. Okay. We have the tax year 2020. We have 2021. And then we have 2022. You need to make sure that in order to claim the refund, you have 3 years from the original due date, or you have 2 years from when the tax was actually paid. Now, why am I making a differentiation there? Because, again, if you're listening to this podcast, you probably have had taxes due that you couldn't pay in full at the time that they were due. If you made those payments later, you have 2 years from the payment date to claim a refund, because maybe you're working with an amazing tax professional that amends your return and you find out you didn't actually owe that money anyway. That would be the type of scenario that would fit in. Now, if this amazing tax professional amends your return, you find out that you were actually due a refund. If you have a balance on another year, the IRS will say, congratulations, you get a refund for this year, and we're going to take it and apply it to your other tax debt. So don't get too excited. It is going to bring your overall tax debt down, but you're not going to see that money in your bank account if you still have a balance on another year. Now you may be thinking, how will I know when I actually made the payment? Because maybe you didn't pay by check. Maybe you can't find the information online. This is a reason why I always start the process of tax relief with the tax transcript. And I break that down in a different episode, the 3 phases of tax relief. And I also have an episode specifically on the tax transcript and what it's useful for. If you have taxes that you feel you overpaid, you want to make sure you check out those episodes so you know how to get your transcript and find the dates that you actually made those payments. Now, moving on, the times that I've mentioned so far have been 3 years to keep a tax return. Pretty much a rule of thumb, but there are other scenarios where it's suggested that you keep it for 7 years, 6 years. There are even a few that are indefinitely, but you guys know how I always give you the secret sauce? Well, just keep listening. I'll let you know how you don't have to keep your tax documents indefinitely. If you claim a loss on your tax return for bad debt or worthless securities, it is recommended by the IRS that you keep your tax documents for 7 years. Now, bad debt, that's going to be for my accrual-based business owners. If you were cash basis, you don't have bad debt. Now, I'm not saying that you don't have invoices that clients may have skipped on. Bad debt only applies to accrual basis because if you're not familiar with the accounting term, when we have a cash basis tax client, they're going to record the income only when the cash touches their hands, okay? If we have an accrual basis taxpayer, they are recording income when the service is provided or the product is delivered. So for example, this is only an example because I know none of my amazing listeners would do this. Let's say we have a tax professional that is accrual basis and they prepare a return. They give the client the invoice because for whatever reason, they do the work before having the client pay. The client doesn't like the result, so they don't pay the invoice. Well, what that accounting professional can do is they can create a bad debt expense account. And the reason that they are going to have this bad debt is because they know it's not going to get paid, but they've already recorded that transaction as income. Because remember, accrual basis taxpayers are recording the income when the service is provided or the product is delivered. So that's an example of where bad debt would come into play. It's not because you loaned your cousin Johnny money and Johnny didn't pay you back. That's not considered bad debt in the IRS eyes. Unless you're a business owner in the business of giving loans and your cousin went through your business and didn't pay it back. But that's a little bit different. That's not what we're talking about today. Next, we're going to look at 6 years. It's recommended that you keep your tax documents for 6 years if all income was not reported on the tax return, and if the income not reported is more than 25% of your gross income. Now, family, doesn't that sound a little sketchy? So don't intentionally not report your income, especially 75% of what you actually should have reported. Nah, that's going to have more penalties than you want to deal with and not even worth it. I wouldn't touch it with a 6-foot pole. But IRS recommendations, so I'm just giving you the details. If you are underreporting your income, make sure you keep your tax documents for at least 6 years. Now let's get to indefinitely. And I hope you're ready for this. The secret sauce here. You can avoid not keeping your tax documents indefinitely, one, just by filing your tax return. What do you mean? The IRS, no joke, recommends that you keep your tax documents indefinitely if you don't file your return. Now, why is this? You may be thinking they only have 3 years. They only have 10 years to collect. They have 10 years to collect this tax debt based on when the tax is assessed. If you never file the tax return, the tax is not assessed. So to protect yourself, you need to make sure that you keep those tax documents. What does that mean? When you file a tax return, the IRS will acknowledge that they received it. Then they will process it and they will let you know how much tax is due. That is a tax assessment. Sometimes, if you don't file your tax return, they'll file one on your behalf, which is called a substitute for return, or SFR, and that is considered a tax assessment. When that happens, the IRS has 10 years from then to go ahead and collect. I'll give you an example. I have a client who has a huge tax bill, almost to the tune of $100,000 from 2018. When we first met, they let me know they never filed 2018. So again, you all know the first step of the process. I checked out the transcript, and guess what the IRS did for him? They said, "Merry Christmas, pal. We went ahead and assessed the tax for you and did an SFR." So when the IRS does that, that is the date that the tax is assessed. And by the way, it was a 2018 return that he could have had done in 2019. IRS didn't assess it until 2021, which means they're going to have at least until 2031 to collect on that debt. All right, so let's look at another situation where it's indefinite. You can avoid indefinitely keeping your tax documents if you file a correct return. Yes, if you do right, you'll be rewarded. The IRS recommends you keep your documents indefinitely if you file a fraudulent return. Folks, that should go without saying, but apparently somebody needed to hear it. If you have filed a fraudulent return, the 10-year statute goes out. The IRS can come and get you indefinitely. They have an unlimited amount of time to come back and collect any taxes from you. So you want to make sure that if you don't know what you're doing with your taxes, you are working with a tax professional that you trust and is knowledgeable. And if you're searching for that right now, again, on a previous episode, I break down what to look for when hiring a tax professional. For my small business owners, if you pay employees, the rules for employment taxes are a little bit different. So those are going to be your Form 941s. And so 941s is for federal income tax withholding. Your 940s are going to be the FUTA, which is the federal unemployment tax. And then you want to make sure that you keep all W-4s and then any W-2s, that kind of information as well. You want to keep those records at least 4 years after the date due or paid. All right. So, unfortunately, some businesses can't keep up with payroll taxes, and maybe you have something that's filed and it wasn't paid yet. You want to keep it 4 years from the time that it was actually paid. And I just want to throw this out because I've brought it up twice, filing returns and you don't have the money yet. That is exactly what you should do. You want to make sure that even if you don't have the money, you still go ahead and file the returns timely to avoid any type of failure to file penalties. Okay? So last but not least, we're going to look at how to store these documents. I don't know about you, but I don't like to have a bunch of paper and stacks everywhere. You want to make sure that if you have these records on paper, that you are storing them in a fire-safe container. Because again, if we're looking at things that the burden of proof is on you, you have to substantiate, the IRS isn't necessarily going to have record of those events and things that happen. So make sure you have this in a safe place, because you don't want to chase down former employees and ask them to fill out W-4s because they're probably going to tell you to buzz off. Make sure that you have everything where it can't be harmed, which takes me to the next step. You probably want to go ahead, if you aren't paperless, go a little bit paperless and have these documents electronically. It's a more efficient use of space, and also you can go ahead and start shredding these papers. Now, I know we went through a lot here. You may have to listen again if you didn't listen to me the first time and grab that pen and paper. But the reason I want to make sure that you have this information, I'm working with a client right now, and we are actually looking at documents from 2013 because I'm working on a failure to file penalty, and the records that she is going to provide me with, they're going to help us to be able to get that penalty removed. So if you owe for a certain year, make sure you keep all of those records, especially. And you know why? Because back taxes shouldn't ruin your life. I'd like to thank you for taking the time to listen today. I'd like to thank Jim Ray Consulting Services for helping me get this message out to you. I hope you found the information helpful. Did you know 1 in 50 people have a tax problem? Please share this episode with your friends and family, because you never know who may need help. Again, thanks for listening. Hey, just as a reminder, this podcast is for informational and educational purposes only. It provides a framework and possible solutions for solving your tax problems, but it is not legally binding. Please consult your tax professional regarding your specific tax situation.